Welcome back to Chapter 2 of Financial Accounting. I like to tell my students that this is the most important chapter in your financial accounting textbook because there is some core material in here that will help you throughout the rest of your financial accounting course. With that, I usually like to begin with a grand overview of how all the financial statements work together and what is an asset, what is a liability, what is shareholders' equity. All of those things I think are imperative to getting a full grasp on how accounting interrelates with one another. So with that, we're trying something new today. I'm trying to do this as if we're working on a screen, or rather working on a whiteboard in my classroom. So let's see how this plays out. We're going to start off, the very first statement is we're starting off here with the income statement. And let's see if I can treat this the same. Okay, so what we're trying to do here is I'm trying to use this as a whiteboard. We'll see how well it goes. I've done this a few times already and rewound my recording. Let's hope that this is the successful time of doing this. The first statement we're going to start off with is the income statement. And keep in mind, please, that this is a really rough version of, really rough breakdown of how these statements work. We'll get into them in a lot of detail in future chapters. So the kind of items that you have in the income statement are primarily revenues and expenses. So you've got revenues, are money coming in or money that you've earned. Okay, revenues represent money that you've earned. So depending on what it is that you do in your business, perhaps it's you mow lawns. That's the example I use in my course. If you're mowing lawns, every time you go out there and you mow a lawn, you've earned revenue. And here it is that shows up in the income statement. It doesn't matter necessarily when you get paid for mowing that lawn. That's not really relevant because we are using accrual-based accounting. That's ACCRUAL, accrual-based accounting. So the important thing is to record revenue when you've earned it, or you've done the work to earn the revenue. From revenues, you would subtract any expenses you may have had in order to earn that revenue. And expenses, let's say, keep with the lawn care example, any expenses you might have along here might be gasoline expense, utility expense, rent expense, maintenance expense, lots of expense, wage expense, income tax expense. There's lots of expenses, I'm sure most of you know, with running your business. So it'd be revenues minus any expenses. And I'll include it here for now, even though we're not going to really talk about it so much until a future chapter. But any gains or losses would also be here as well. So you would have a plus minus for any gains or losses. That would also show up here. Let's see if I can get that in here. Plus minus gains or losses would also be in here. And the end result of all of this is going to be, anybody guess? Net income. The whole point of the income statement is this is where it shows whether or not you have made any money running your business, doing what you do, whether it's mowing the lawn or selling records, or I'm dating myself. They probably don't even have records. Records aren't a big sale anymore. But the idea is you have either net income or, hopefully not, but you might have net loss as well. Loss would be minus. That's ultimately what your income statement does. And your income statement is for a period. Often it's for a year period and to keep it simple, we'll stick with a calendar year, but it might be from January 1st through December 31st of any given year. You would record all of the revenue for that period, all of the expenses that you needed to incur, and we'll talk about that in a little bit, in order to earn that revenue, adding any gains or losses, and you would wind up with net income or loss. And this is the first financial statement that you would be working on. And of course, this is one of the most important ones. Think about it. This is the financial statement that says, did I make any money doing what I'm doing this year? So this financial statement is, by all means, a core financial statement. Now from there, and let's see if I can do something here. From there, the next statement that would be prepared would be the statement of retained earnings. So let's try to get that in here. Statement of retained earnings. This could also be called, statement of stockholders' equity or the statement of shareholders' equity, any of those things. And what that shows is it starts off with what do you have in your business? What is your equity in the business? What do the owners own of the business? What is their value of their business to them? You would start off with a beginning balance. If you had a brand new company, this beginning balance would be 0. But, well, we're using X's here. You start off with a beginning balance. So if your company had money that it held on to from last year's earnings, then you'd have a number in here. But otherwise, you'd start off with 0 if it was brand new. From here, you'd add in any net income or subtract any net loss. Again, I'm going to keep it simple and go with net income and loss like this. Oops. So let's hope that you actually made money this year doing whatever your business is. We'll say that's added in to the statement of retained earnings. Okay. From there, what if your business, you did really well this year, you cut a lot of lawns, you made a lot of money, you decided you need to reward yourself with a trip to, let's say, Tahiti. Okay, you're going to Tahiti, and you decided that you needed some money to come out of the business. Well, that might be referred to as dividends, when money comes out of the business and goes into basically the owners of the business's pockets. So at the end of the day, let's do a line here. At the end of the day, the amount of money that you started with, let's just say 0 for the beginning balance, plus any net income that you made, minus any dividends you took out, is the ending balance of your business, of the equity in your business. So, just to reiterate here, you start off with a certain amount of money, let's say 0 because it's a new business. Any money that you might have made gets included in your business because this is your statement as the owner. Did your business make money? Here's where it shows up. It is coming directly from over here. This ties directly here. So net income comes in. And then if you took any of the money out of the business, if you didn't take any of your money out of your business, then wonderful. Then this number would be 0, and all of your income that you made this year would add together to this ending balance. And that would reflect the money in your business. Okay, so these are the first 2 statements. They're not very pretty on the screen here, but I'm doing my best. Let's work on a third statement here. The third statement that we're going to work on together is going to be called the balance sheet. No, the balance sheet. Oops, that's not what I wanted. Here we go. Let's work on the balance sheet. The balance sheet is a snapshot of how you're doing at a particular date. So normally if we're doing a calendar year company, January 1st through December 31st, the balance sheet would be a snapshot of exactly how you're doing on December 31st. Because the thing is that items on the balance sheet change. Cash comes in, cash goes out. Oh, I'm getting ahead of myself. But the idea is the balance sheet changes from day to day. The income statement reflects all of the income that you've earned for a period of time. The balance sheet is where are you as of December 31st, 2010, if that's the date you're using. The balance sheet's going to have on it 3 categories. Assets, and in your assets you're going to find things like cash, supplies, accounts receivable. Okay, all these things you can find more detailed descriptions of in your book. I'm not going to go into them so much here, but the idea is that assets are really the resources that a business owns. Okay, so you're going to have in here also things like land and buildings and cars. All right, these are the resources of your business. The second category you're going to have are going to be liabilities. And really, the easy way to think about it, at least for you guys right now starting out, is anything with the word payable at the end of it is definitely a liability. Liability is something you owe to someone. Alright, now I like to say it that way because a liability isn't always cash. You don't always owe somebody cash. Sometimes you owe somebody a service. For example, what if somebody gave you money to perform a service? Maybe somebody paid me $1,000 up front for lawn cutting, but I haven't cut their lawn even once yet. In that case, that would be a liability. It would be something called unearned revenue. I wouldn't have earned the money yet, so in that case I owe them something. I owe them the service of my doing their work. And the final section here is going to be owner's equity. And owner's equity is going to have things like stock in here, common stock, preferred stock, again, which we'll get to in a lot in a future chapter. But really, the important thing that I want you to realize what comes from an item that goes into here is from the previous, oops, can't get down there, is from, all right, I'm going to have to get rid of these so I can type in here, is going to be from the previous page that we were working on, that final balance in the retained earnings statement. All right, that number is going to come over to here from that statement of retained earnings. So what's going to happen is these three sheets are tied together. You really have no choice but to do them in this manner, because you start off with the income statement. It says how much money you made during the year. The second statement, statement of retained earnings, says how much money did you keep in the business this year and did you take any out. And the third one's going to be the balance sheet, where you start off with talking about all of your assets, you list out all of your liabilities, and then you say what is the owner's equity in the business. Now, owner's equities, assets kind of make sense, liabilities make sense. It's, for the most part, relatively intuitive. But owner's equity is something that's a little bit more difficult to get your head wrapped around. So I like to use a simple example in my classroom. That simple example I'll put right here. Most of you guys know about houses and mortgages and things like that, at least in the simplest form. Think about if you had a house, and let's say that house was worth $700,000. Okay, and that house has a mortgage of, let's say, $200,000. Your equity in the house, oops, there should be a line lower here. Your equity in the house, space, is $500,000. That's going to be your equity in the house. So the way that the balance sheet works is actually based on this little formula I'm going to put up right here. Assets minus any liabilities equal owner's equity. That little equation right there is pretty much one of the most golden equations of accounting. Assets minus liabilities equals owner's equity. And if you think about it, if you had all of these assets and you subtracted all the liabilities, everything that you owed to somebody, right? Everything was gone. You paid everything off. What's left over in your business would be your equity in the business. So with that, you can have assets minus liabilities equals owner's equity. Another way to look at it, and this is the more standard way the equation works, is assets equal liabilities plus owner's equity. Okay, and this is really the golden accounting equation. For my example, it worked this way, but ultimately they're exactly the same equation. I just moved liabilities around a little bit there. But assets equal liabilities plus owner's equity. You're going to see this time and time again, so get used to the equation. All right, what I've drawn for you here was quite painstakingly drawn, I might add, but what you're looking at here is you're looking at T accounts, and you can see why they are called T accounts. You've got assets, liabilities, and owner's equity. Assets, again, are things like cash and such, and liabilities are things that you owe people, and owner's equity is comprised, actually, from our previous discussion, is comprised of a number of things. Owner's equity is not just its own number, but it's actually combined of all of the components of the income statement, right? All of the revenues, all of the expenses, and then you would take away dividends and things like that. And all of those things from the previous balance, from the income statement to the statement of retained earnings, all flow together to be a final owner's equity. So all these accounts that build together to be owner's equity are all considered owner's equity types of accounts. And I've got a little note here. Debit equals left side and credit equals right side. So forget everything that you've ever learned about debits meaning things go up or down, and credits mean things go down or up. You have to leave all of that at the door when you come into financial accounting, because we're getting down to the core of what does a debit and a credit really mean, and many times you hear them in the wrong context out there in the world. So you got to leave all that stuff at the door, credit cards, debit cards, all that kind of stuff, and just concentrate on debit equals left side and credit equals right side. Okay, to be continued on the next set here. Hang on.